So as Hal mentioned, really trying to focus on quality of information. With the revenue standard, prior to the new revenue standard, the board would set standards for revenue based on the type of transaction that was present. And so as transactions evolved, they would issue new standards. And so that really resulted in almost over 200 individual pieces of revenue recognition guidance, some specific to software, some specific to construction contracts. And there was a lot of judgment, and people got lost as to what revenue guidance was being applied. And so the board, to address that, really came up with one principles-based standard that would apply to all types of transactions, all industries, and really that cohesive framework. And so would result in better quality information, because then users didn't have to understand what specific industry am I looking at, what accounting guidance do they have versus what I've looked at in another industry. And so what's the principle then? So it's one principles-based standard. It's a pretty simple principle. So you recognize revenue to depict the transfer of goods or services to a customer in an amount that reflects the consideration that you'll receive for those goods or services. So seems very, very straightforward and simple. But then when it's applied to different transactions, that's when it becomes a little bit more complicated. And so the board developed 5 steps to apply that core principle. And so step 1 is identifying the contract with the customer. So what is actually resulting in legal rights and obligations between the vendor and the customer? Is that just a purchase order? Is it a master service arrangement? Is it a combination of those? And so really step 1 is saying, what is your contract? And then from there, you're looking at, well, in that contract, what are all the promised goods or services that are being provided? And then that step also says, well, which of those should be accounted for separately as opposed to just one overall promise? Then in step 3, I always say you take a step back, and now you're back at the contract level, and you say, what is all the consideration that I'm going to receive? Variable amounts, non-cash consideration, all of those different types of consideration you look at in step 3. And then in step 4, you allocate that total pool of consideration to the separate promised goods or services that you identified in step 2. Then finally in step 5, you take those promised goods or services and the amount that's been allocated to it, and then determine when do you recognize revenue for those promised goods or services, at a point in time, over time, as those goods and services are provided. So this is a new way of thinking about revenue for a lot of different companies. And in some instances, they're getting back to a similar answer of timing of revenue recognition as they have previously. But it is a different way of thinking about it, and it is a model that's consistent across all industries and types of transactions. Where we have seen a lot of changes, where probably the most significant impacts are going to be, are some of the items on the screen. So a company that has licenses of intellectual property, long-term construction contracts, reseller arrangements. So if you've got a distributor who was previously following the sell-through method, they're going to see some changes here. Free products or services that are offered as sales incentives, they're now going to have revenue allocated to those quote-unquote free products or services. Contracts with variable payments, or then situations where the company is paying sales commissions to their employees. In those cases, the revenue standard has guidance about capitalizing some of those commissions. So because of those different types of transactions that are going to be affected, you're going to see a lot of different changes on the financial statements. So in certain cases, revenue might actually be accelerated. In certain cases, it might be deferred, depending on the transaction. There will be additional balance sheet items, so potentially additional capitalized costs or contract assets. Then, based on the timing and change in timing and revenue recognition, it's going to result in changes to deferred taxes, and as well as new disclosures. And so because of all of this and the new way of thinking about it, companies are really making changes to processes, their internal controls, and then even a lot have looked at new software that they can use to track the revenue. And so they're making changes there. Now, one of the things that I think is great, the best part of this standard, is user focus. So previously under revenue recognition, there were very few required disclosures. But under the new standard, there's this whole disclosure package. And so companies will have to disaggregate their revenue and show different types of revenue in their footnotes. Amounts that related to prior performance. So if they recognized revenue in the current period, but it actually related to prior performance, you'll see that disclosure. Then as well, information about the contracts, the performance obligations. And then the third one under contracts is amounts allocated to remaining performance obligations. So this is the case where the company has amounts that are contracted for, but hasn't been recognized as revenue yet because they haven't performed. So very useful information to users. And then information about significant judgments. Now, so when is this standard effective? For calendar year-end companies, it's 1/1/18. So we're right in the middle of the first quarter of the new standard. And so there's two choices for transition. And so as an investor, you might see it two different ways. One is full retrospective. And so in their 2018 10K, you'll see 2016, 2017, and 2018 all shown under the new standard. If an entity chooses the cumulative effect approach, what you'll see is in that same 10K, you'll see 2016 and 2017 under the old guidance, but then 2018 will be under the new guidance. To allow for comparability, though, they will have to disclose in their footnotes what 2018 would have been had the old guidance been applied. And so you'll still see that comparability between 16, 17, and 18.